Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone. Today, we're really plunging into a deep dive, looking at some of the biggest financial stories making waves. We're pulling from, our usual sources like MarketWatch, Bloomberg.
Absolutely. And it's a really compelling mix today, wouldn't you say?
Definitely.
You've got these themes, international trade, the constant question about interest rates, technology, especially AI, naturally,
Right.
and then this kind of undercurrent of global economic feeling, confidence,
Mm.
or maybe lack of confidence.
Okay, let's unpack this because when I was reading through the headlines, it's really striking how these different areas are, well, bumping up against each other.
Yeah.
You can't really talk about one without bringing in the others. So our mission today, like always, is to cut through that noise, sift through it all,
Mm-hmm.
and pull out the core ideas, what really matters for you.
Precisely. It's about getting past just the headlines, right? Understanding the so what, the connections, the potential fallout.
So let's dive straight in. Tariffs, the trade landscape. There's buzz about a potential US-UK trade deal. MarketWatch has what's expected and what isn't from the US-UK trade deal, and Bloomberg's covering it too. UK markets see muted reaction to trade deal hope before BOE.
Yeah, and what's interesting right off the bat, like that Bloomberg headline says, is the kind of lukewarm reaction from UK markets.
Right, despite the positive noise.
Exactly. So the report suggests the deal probably keeps the existing 10% global tariffs from the U.S., but the UK might see lower tariffs on its cars and steel exports.
Okay.
And the U.S. could get lower tariffs on car imports from the UK, meat, shellfish, and there's talk maybe the UK dials back its digital services tax too.
So some specific wins for certain sectors, maybe, but like Bloomberg pointed out, the FTSE 100 didn't exactly soar on the news. It lagged a bit, which is really interesting. It's just that even with good trade news, the focus in the UK seems locked on the Bank of England. Everyone's waiting for that interest rate cut.
That muted reaction.
Yeah.
It could mean, markets are a bit skeptical about how much these bilateral deals really move the needle right now.
In the grand scheme of things.
Yeah, especially when you've got bigger forces like monetary policy in play. It just shows that interconnectedness we mentioned. Trade news isn't the whole picture.
Exactly. And that takes us right to the broader impact of tariffs. MarketWatch has some really telling stuff. Global growth bellwethers, Maersk and Toyota lower guidance on tariff impact.
Ooh.
Yeah. And then the Fed's view. Fed stands pat on interest rates and warns of economic woes on the horizon, which Bloomberg backs up with. Powell says Fed won't be rushed. Outlook depends on White House. It paints a picture of, well, wider concern.
Oh, absolutely. Take Maersk, the shipping giant. MarketWatch says they've really lowered their expectations for volume growth this year.
Significantly.
Yeah, they're basically saying they'll just grow in line with the market now. That's not a small tweak. They're directly blaming the drag from tariffs on, global trade flows.
It's a real-world signal. And it's not just shipping. Look at Toyota. MarketWatch says they're projecting, 180 billion yen?
Which is about, 1.2 billion US dollars.
Just for April and May. Because of tariffs. And that made them cut their operating profit forecast. The article mentions other car companies are sounding alarms too.
These aren't hypotheticals anymore. It's hitting the bottom line for massive companies.
So when companies like Maersk and Toyota, these bellwethers, start lowering guidance.
It's an early warning, potentially, for broader economic growth. Their business is so tied to global demand, global trade. If they're worried about tariffs, it suggests a possible wider slowdown.
So amidst all this tariff talk, what's the Fed doing? Both MarketWatch and Bloomberg hit this point. They kept rates steady.
Right, no change.
But it's the why that's interesting. They're sounding more worried, aren't they? About higher unemployment and maybe even higher inflation, which seems weird in a high tariff world.
It does raise questions about their strategy. Bloomberg quotes Powell saying pretty clearly the Fed won't be rushed into cutting rates.
Waiting for clarity.
Yeah, clarity on trade policy, specifically from the White House. The uncertainty around tariffs, what's next, how long will there be more, that's making the Fed hesitant to move on rates just yet.
So the Fed's kind of waiting for the trade dust to settle before tweaking monetary policy. But Bloomberg also notes that despite the Fed's caution, a lot of economists, the futures markets, they still seem to think cuts are coming later this year.
Yeah, it's like a disconnect.
Why is that?
Well, the market might be betting that the negative economic hit from tariffs will force the Fed's hand eventually, even if the Fed isn't signaling it right now. That difference in outlook It can definitely stir up market volatility.
Okay, so tariffs are casting this really long shadow,
Yeah.
affecting companies, tying the Fed's hands a bit. Let's switch gears. Currency markets. MarketWatch has this headline. Wow, a currency market avalanche is heading for the U.S. dollar, and the tremors started this week. That sounds big.
It does sound dramatic. The core idea in that MarketWatch piece is about these huge trade surpluses that major Asian exporters, they mentioned Malaysia, Taiwan, Singapore, China, Vietnam, have built up with the U.S.
Huge chow.
Since early 2020, we're talking a combined total of like $2.5 trillion, and it's still growing, maybe $500 billion a year.
Wow.
And the article suggests a lot of this might be parked in really liquid stuff like money market funds that don't always show up clearly in the standard international investment data.
So a massive tool of dollars, maybe sitting slightly off the radar, and the avalanche part that suggests it could all move suddenly. What's the risk to the dollar?
Well, the article mentions a Barclays team thinks a forced sudden sell-off is unlikely compared to 2022.
When rates were rising fast.
Exactly. Rising U.S. rates hurt the value of the dollar bonds these exporters held. But the argument is these long-term holders, these lifers, they wouldn't want to lock in big losses by selling suddenly.
Makes sense. Nobody wants to sell low.
Hmm.
But the article points out a difference from 2022, right? Back then, the dollar itself was strengthening.
Right, which helped offset some of those bond losses when they converted back to their local currency.
Bro.
Now it's more complicated. Treasury yields did pop up recently, but one economist in the article thinks that was more about the strong jobs report, not some massive sell-off by these Asian holders.
Okay.
So maybe not an imminent avalanche,
Yeah.
but the sheer size of these dollar holdings is the point. If these big players ever did shift their strategy significantly.
It could really move the needle for the dollar.
Exactly. Think of it like this huge reservoir of dollars held by these countries. If their investment preferences change, or they think the dollar is weakening, they might start diversifying,
Yeah.
selling dollars for other assets or currencies. That could create serious selling pressure. That's the avalanche idea.
It's like this potential energy stored up. Definitely something for you to keep an eye on. Okay, pivot time. Tech sector. Always fascinating. MarketWatch asks, Alphabet stock is sliding on AI fears. Are investors overreacting?
Seems like AI excitement also brings AI anxiety.
It's amazing how fast sentiment can flip, even for a giant like Alphabet, right?
Yeah.
MarketWatch says the stock dropped, what, over 7%?
Yeah, quite a bit.
And it was triggered by comments from an Apple exec in that DOJ antitrust case testimony. He basically said Apple is actively looking at using AI search engines in Safari.
Ooh.
And then there was another report saying Safari searches actually dipped in April.
Yeah.
First time ever. Maybe people are already playing with AI tools instead.
So the fear is these new conversational AIs, ChatGPT, Google's own Gemini,
Yeah.
they can start eating into Google's main business, traditional search.
That's the core fear. Search is still Google's cash cow, drives most of their profit. So any threat there gets investors spooked.
Understandably. But the MarketWatch piece also brings in analysts from Baird Equity Research. They think it might be a knee-jerk reaction, an overreaction.
Why?
They argue that, yeah, the competition's changing, but these AI search startups, they're still tiny compared to Google's search volume. They don't have the infrastructure, the ad tech, the mountains of data Google has.
The moat is still pretty wide.
That's their argument. They think it'll take a long, long time for anyone to really challenge Google, especially on the money-making advertising side.
That's a key point. Google's advantages are huge. And didn't Apple's Eddie Q kind of hedge his bets too? Said they're looking at AI search from others, but it still needs work.
Yeah, exactly. He acknowledged that AI search needs to get better. He thinks eventually it will be so much better that people will switch, but maybe not right away.
Still, there was that analyst in the article, Milius Research, compared Google to Kodak.
Ouch. Yeah, that's the stark comparison.
Yeah.
Kodak missed the digital shift entirely. It really highlights the potential for disruption if Google doesn't navigate this AI transition perfectly.
It's that classic innovator's dilemma, isn't it? How do you protect your current profit machine while also building the next big thing that might disrupt it?
Precisely.
Okay. Sticking with tech, but moving to the hardware. AI chips. Huge deal. We've got a couple from MarketWatch focusing on NVIDIA. Why NVIDIA investors are cheering Trump's likely dismantling of Biden's AI chip rules.
Interesting.
And then a really strong quote from Jensen Huang, NVIDIA's CEO. He says, NVIDIA is missing a Boeing-sized opportunity in China, not a plane, the entire company. That really frames the tension here. Regulation versus market access.
Yeah. Big tension. So first, the potential rollback of Biden's AI chip rules. MarketWatch says NVIDIA's stock actually got a boost when reports surfaced that the Trump administration might scrap those rules.
Rules meant to control advanced AI tech going certain places.
Right. Getting rid of them could make it easier for NVIDIA to sell top-tier AI chips to places like the Middle East. There was even mention of Trump suggesting maybe easing chip exports there.
So a potential shift in policy. Biden's rules aim to limit access, maybe for security reasons. Trump might prioritize market access, exports.
Seems like it. And NVIDIA, being the leader in these chips, apparently likes that direction. They called the Biden rules misguided before, a threat to U.S. competitiveness.
Okay, and what about Jensen Huang's Boeing-sized opportunity comment regarding China?
That really highlights their frustration with the current restrictions, particularly on exports to China. Huang estimates the China AI chip market alone is worth potentially $50 billion.
A massive number they're missing out on.
Exactly. And his argument, laid out in the articles, is twofold. One, it hurts NVIDIA's revenue. Two, he argues these restrictions probably won't stop China's military advancements anyway.
How so?
He basically says if China needs that computing power for military stuff, they'll find a way. And if U.S. companies like NVIDIA can't sell to them, then Chinese companies like Huawei will just step up and fill the gap.
So the argument is, restricting sales might just hand a huge market to competitors without achieving the security goals.
That's the essence of it. The Boeing-sized, quote, just hammers home the scale of the market they feel locked out of.
It really captures that complex balancing act. Economic interests, tech leadership, national security, all tangled up in regulating these critical chips.
Absolutely. It's a major dilemma.
So let's step back a bit. With all these things swirling, tariff fears, rate outlooks, tech disruption, how are investors feeling overall? MarketWatch has a pretty stark headline. Investors say this is the toughest investment climate they've ever experienced. That's quite a statement.
It's a really strong statement. There was a J.D. Power survey mentioned in the article. Over half of investors, 56%, think right now is tougher than the 2008 crisis, tougher than the dot-com crash.
Wow. Across the board.
Seems like it. Different ages, experience levels, they're feeling it.
And what's driving that feeling? The article mentions volatility from the tariff talk back in April, but it sounds like it's deeper than that.
It seems to be the fundamental uncertainty, especially around trade policy, economic policy in general. It's just really hard for investors to plan, to build strategies, when the basic rules feel like they could change any minute.
Right. The not knowing is worse than knowing something bad sometimes.
Exactly. A behavioral analyst quoted said just that people often prefer a known negative to the anxiety of unpredictability. And this trade policy back and forth creates that constant unease.
Interestingly, the survey also found more people are thinking about getting financial advice, flight to advice.
Yeah, especially younger investors. They're more inclined now to seek professional help to navigate all this turbulence, which makes sense, right?
Totally. When things feel this choppy, having an expert guide can be reassuring. Okay, let's touch on that old market saying, sell in May and go away. MarketWatch has, now there's one more reason for stock investors to sell in May and go away. Any new teeth to that this year?
Well, the analysis in that piece by Mark Hulbert suggests maybe there is. Usually sell in May is tied to a weaker summer performance, often in pre-midterm years, which this isn't.
Right. But Hulbert points out that this past winter, November to April, the U.S. stock market actually did unusually poorly. And historically, when you have a losing winter in a non-midterm year, the summer that follows also tends to be disappointing.
Huh. So it's not the election cycle, it's the hangover from a bad winter. What's the link?
The link seems to be higher economic uncertainty, measured by something called the Economic Policy Uncertainty Index, or EPU.
Okay.
When the market has a rough winter like that, this EPU index tends to be higher afterwards. And higher uncertainty usually means investors demand higher returns to compensate for risk, which can push stock prices down.
So a poor winter leads to more uncertainty, which could mean a weaker summer.
That's the logic. The article uses a turbulence analogy. Rough patches tend to cluster, so the recent uncertainty might stick around for a few more months, weighing on stocks. Good reminder that history doesn't repeat, but it often rhymes, especially when there's an economic reason behind it. Okay, a few other headlines to quickly hit before we wrap. MarketWatch notes, even Republicans are getting concerned about Social Security cutting staff and closing offices. Bipartisan concern there.
Yeah, seems rare, but it's happening. Worries about customer service changes, staff cuts, office closures at the Social Security Administration. 15 House Republicans expressed concern, worried it could delay benefits. The Ways and Means Committee even invited the new commissioner to testify about it.
Shows how vital that program is across the political spectrum.
Definitely.
Also on the personal finance front, retirement savings. MarketWatch asks, Suze Orman says retirees should have a 5-year just-in-case fund. Is this true? And related, another piece noting, Treasury yields rise as Fed's wait-and-see message sinks in, which Bloomberg also covered.
Right. Suze Orman's advice, keep 3 to 5 years of expenses in safe, non-market stuff. The idea is you don't have to sell stocks when the market's down.
But the counter-argument,
It's just really hard for most people to save that much cash. Plus, the opportunity cost that money isn't growing in the market. Meanwhile, those treasury yields rising, that's the market digesting the Fed saying, yeah, we're probably holding REITs here for a while.
got it. And quickly, that debate sparked by the Skim CEO, Emma Grede. MarketWatch had, Skim CEO Emma Grede says your employer doesn't have to provide work-life balance. Why she's wrong. Generated some heat.
Oh, yeah, her view.
Yeah.
Work-life balance is on the employee, not the employer. That gave a lot of pushback. Many argue employers do have a role in creating environments and policies that support balance, especially since workers value it more and more.
It's a big conversation about modern workplace expectations.
For sure. And we also saw Bloomberg reporting the Indian rupee fell sharply on rising India-Pakistan tensions reminder how geopolitics hits markets.
Right.
And Bloomberg had other deep dives too, like a podcast with SEC Commissioner Hester Pierce and news about Republicans possibly looking at selling public land to fund tax cuts.
Lots going on.
And their market summary noted stocks moving on that UK trade deal hint and the Fed's cautious tone, while another piece said the Bank of England might turn more dovish, partly because of U.S. tariffs potentially hurting UK growth.
It really is all connected, isn't it?
Absolutely. Every headline feeds into this bigger picture of uncertainty, adaptation, shifting trade, fast tech, global economic jitters.
So, as you've taken this deep dive with us today, looking at everything from that potential UK trade deal to AI fears shaking up tech stocks to just the general caution among investors, we really encourage you to think about how these big interconnected forces might play out in your own financial world in the coming months.
Yeah, it's about spotting the trends, thinking through the potential impacts, and considering how it might affect your investments, maybe your career, your overall financial planning.
Well, that brings us to the end of our deep dive for today. We'll see you all tomorrow morning with new headlines from major financial magazines.